Hello and welcome, everybody. Thanks for joining us today on the Catholic Money Mastermind. Looking forward to this podcast. I look forward to all of them, if I'm honest, actually. They're super fun. I love bringing the advisors of the network onto the show. That's the Catholic Financial Planners Network, folks, in case you're not familiar with it. There's a group of advisors who have gotten together, and we're Catholic advisors and who are really committed to our faith and wanting to bring about good things, good fruits for our clients. And so, one by one, we're bringing in advisors onto the show as they join the network and giving them an opportunity to, share a little bit about themselves and their background and, why they joined maybe the network and what do they do in financial services and perhaps how can they be of benefit or help to you. And so I'm joined today by one of the fellow advisors. His name is Logan Moore out of, is it Kansas City, Logan? I think I forgot to ask you ahead of that call. Why don't you share? Where do you hail from, Logan?
Yeah, so I'm in the Kansas City metro area, Overland Park, Kansas, to be specific. I was born and raised on the Missouri side. For anybody who knows around here, you're either Missouri or Kansas. So I still wish I could claim Missouri, but you know how it goes. You meet a girl and you move, and but it's Kansas City is where I've been my whole life, and I love it here.
Yeah, and well, in Logan, your business, which is going to be tallied for our topic for today, which we're going to discuss alternative investing and investments and what that means. And Logan has a different designation, but we don't always see within the financial services space, known as the CFA, the Chartered Financial Analyst. And I'm going to tease you a little bit, folks. I won't get into all the details of what that means, but more specifically, like Logan, your business is called Alts Investing. Is that right? Or what's the name of the firm in which people could find you?
Yeah, it's Alts Eval LLC, so ALTS EVAL. It's short for Alternative Evaluations.
And that's the matter at hand here. Is we want to talk about your background and your skill set, which is this topic of alternative investing. Which I must say, when I got first introduced to this was like, well, what is that? Like, is this like alternative rock? Like, what exactly does that mean? And again, I'd like to delve into that in a moment, but maybe before we do, it kind of ties in hand with your designation and your background, which is your work as a chartered financial analyst, which folks, you may have heard, CFPs, certified financial planner, perhaps you've heard of accountants, CPAs, certified public accountant, but you may not have heard a chartered financial analyst. And if you don't know this is like one of the big dogs. That's how I always feel like, someone who's got the CFA designation, this is not an easy accomplishment. One person described it as having like a master's degree in finance with a minor in economics and accounting. So like it really takes some work to get this. But, Logan here on the show has a CFA. And I'm kind of curious just to have you share, Logan, some of what it took you to get that and what drew you, what is the CFA? Like, what do you do as a chartered financial analyst?
So I guess at a high level, the chartered financial analyst, you see it a lot of times with institutional investment firms. Buy-side firms where they're managing large portfolios, whether that's traditional mutual funds, life insurance, investment teams. But it's an advanced finance designation that really focuses on a lot of different areas. Like you mentioned, finance. There's some accounting in there, some economics. Portfolio management, right? How do you weight certain things? And modern portfolio theory is part of the curriculum. But I got it. I guess I first started sitting for the tests about 10 years ago. Maybe actually it's probably a little over 10 years ago. I had a finance degree coming out of college, finance and accounting. Got on with a big mutual fund company. Here in town, Waddell & Reed, and Ivy Investments was the name of that firm. They actually sold to a group called Macquarie about, 3.5, 4 years ago now. But got on through the accounting team, but ultimately wanted to end up on the investment team. And so, CFA with its, recognition in the industry, I thought that was probably a good way to continue to build my resume and show that I at least had the ability to learn what I needed to do to be successful. And so that's when I decided to go through the process and do all that.
Yeah. And folks, if you're not familiar with this, it's 3 exams, minimally it would take about 1.5 years, 2.5 years, I think, to take the exams because they're spaced out and they're given just once a year. And, the passing rate on this is not particularly high. I mean, you really, I think, have to roll up your sleeves and get to work and study. And it's, a lot weight riding on each exam, because if you don't pass it, you have to go a whole other year before you get another chance to take it. And there are 3 different stages as you move along. So all that to say, Logan, is my hat's off to you. I've always had a little bit of a fond admiration with CFAs, with sometimes thinking maybe I should get this myself. But the truth is usually within the financial services space, CFAs is more institutional money management. You may see them on the personal individual level, but it's not common. More commonly, that would take place with a certified financial planner. But what interest to our show today is that a chartered financial analyst really is somebody who can get into the details of an investment and then provide additional insight or guidance as to whether or not that particular investment is maybe worth pursuing. What do we think this is a good use of your money or capital? And so, Logan, as you were in your career and working through, working for these larger institutional, funds, I suppose, as a portfolio manager, some of your work and background was, making, in these funds, these are all composed of other underlying investments, and you have to make decisions about whether or not the fund should buy this investment or pass. Is this a good deal? Which I think is at the heart. I want to hear a little bit about some of the decisions that you were involved in that prior space, but like your focus in alternative investing, like that's like part and parcel of what you do now. So like how's your experience been, I suppose, in like deciding like whether or not an investment, not an investment fund, but like a particular investment, like, I don't know, let's say buying, a strip mall or something, what are some of the things that you were doing when you were working in the mutual fund space to make determinations of whether or not like that would be a good use of somebody's money?
Yeah, no, I think that's a good description. It was, when I moved from the accounting department to the investment team, I came over as an analyst, right? So it's what you think of when you think of typical fundamental, bottoms up security analysis, right? And I specifically was working on the municipal fixed income team, which includes, things like your government debt, right? Your general obligation bonds. When you think of high grade or high quality investments. But what I did spend more of my time doing, especially as my career advanced and I got more experience, was in the high yield space, the riskier debt, if you will, which in municipal bonds is a lot of project finance on a number of type of different asset classes, but there's a lot of real estate tied to it. So looking at anything from lending against senior living facilities, charter schools, what we call special tax districts, hospitals, all kinds of different projects. And there's some utility stuff in there, but a variety of things. And so the fundamental analysis was really digging into the weeds of what is this investment opportunity here? What are these proceeds going to finance, looking at the background of the company or the entity that was going to be managing the project, doing economic analysis, what's the local market look like, doing financial analysis from anything, how much leverage do they have, what are their projections looking like, do they need to grow rents or have certain levels of occupancy to make this work. And then, as part of that, also looking at things from the perspective of, risk reward, right? Am I getting compensated for the amount of risk that I'm taking? So if, all else equal, one deal pays 5%, the other one pays 5%, but one is using more debt than the other, again, all else equal, the one with less debt would seem to be a better risk reward adjustment. So that's part of the analysis too, that goes into it, of not just can this deal make money, but am I getting compensated for the perceived amount of risk that I'm taking?
So, I mean, you're working with this mutual fund or the company, and part of your responsibility on this team is, deals come up or you're coming across them, and, someone has to sign off and say, hey, yeah, we think this is, we should buy this as a fund. This is part of our objectives. This is getting us, where the fund needs to go. And maybe just as a matter of clarity, folks, you may be buying the mutual fund, and perhaps it's being offered to you by a financial advisor, like someone you would more commonly see in our space who says, hey, this fund has done really well. Look at the returns. We have good reason to think that the returns will continue on. It's the chartered financial analyst. The work that Logan is doing is the person behind the scenes in the wiring of the fund, if you will, making those determinations with the fund's capital to make all those investments work. So maybe the advisor is telling you about the fund's returns, but it's Logan who's trying to make sure that the fund's returns continue. Like it's great. Maybe the fund had good performance, but we have to keep that performance going. So, so was most of your background or space, up to that point in time, largely in it sounds like high yield, highly leveraged debt, government debt holdings, or did you start to expand into the real estate space, or how did things go? I think from the initial focus on bond holdings.
Yeah, I mean, it was municipal debt, but I think a better municipal debt's maybe too narrow. Tax exempt debt's probably a better way to say that. They were a lot of them were 501c3, not-for-profit type entities, right? So a charter school, you're lending against the project that they're building, and it's in the municipal space because charter schools are public entities, right? But ultimately, part of your analysis depends on the real estate that you're lending against, right? And so there was that real estate component to it. After that, so I did that for 6.5, 7 years, and took on some, as you mentioned, portfolio management responsibilities where I wasn't just doing the analysis, but I was working with the lead fund manager to determine how do we want, what sectors do we want to be in, how much do we want to invest in any one deal, where do we think the market's going, some of those big picture things. So I did that towards the latter half of my time there. But then from there, I went and joined a college friend of mine in his commercial real estate fund. And so that's when I was directly managing real estate. If listeners, so I guess without trying to get too into the nitty gritty, you have what's called a general partner and a limited partner in typical real estate syndications, where you're raising, the general partner's raising the money, underwriting the deal, buying the property, managing the property, or hiring somebody to manage it for them. And they're taking certain risks of running that property. And then ideally, they make money at the end when, if the deal performs well. On the other side, you have limited partners, which are the investors, right? They write a check and hope that the general partner does a good job. So that's what I did for 3 years after I was in the investment management space or the mutual fund industry, was actually running and operating those projects, raising capital from investors, setting up the offerings, underwriting new opportunities, and then also, key to the mutual fund industry, but also in the real estate industry is monitoring things on an ongoing basis, right? Is everything performing as you expected it to? If not, why?
Sure. So you partnered with another gentleman, and the two of you within your fund offering were both general partners seeking limited partners, and ultimately investors is what we really mean when we say limited partners. To buy into these various activities that you're pursuing, saying, hey, let's work together. You have the money, we've got the management and the smarts and the brains, and we're gonna try to bring the two of these to make returns and a win for everybody. So just to confirm that, then your work, Logan, with your other partner was you were both functioning as general partners in those syndicates.
That's correct. We actually had a third partner as well, but yeah, we on our side, had a breakdown of who owned what percent of the general partner, and then we were trying to raise money from high net worth individuals who a lot of times doctors or engineers or salespeople who make a lot of money, but they just want to write a check to somebody and let them invest it for them.
Well, and that's just a great segue that's happened, rather well. That the conversation at hand is to discuss alternative investing, and I teased you or the audience earlier with what is alternative investing, and what we're really getting at is that there are investment opportunities outside of what you might commonly see within what we call the capital markets, which would be stock, bond, either individual securities, individual companies, but most commonly you see them structured through mutual funds or exchange traded funds, ETFs. And so when you're typically, investing within a 401k or an IRA or with an advisor, you're buying these exchange traded funds, mutual funds, these various retirement accounts that you might have, again, with your employer's 401k. So that's the conventional norm and model. And part of the reason why that works well is, all these securities are what are called registered with the Securities and Exchange Commission. And that means they've got at least some level of due diligence that's been done by them, in which, the federal government feels that, I wouldn't say that they're safe, because none of these securities are certified, but, they've passed a certain bar. And so they're open and available to the general public. You don't necessarily have to be an advanced investor, if you will, to participate in them. But there's this whole other segment, the alternative investing space, that in order to participate in that as an investor, you have to be what's called an accredited investor. And this, individual isn't just anybody. You have to have certain income or net worth parameters, either of us, an income usually of $300,000 if you're married filing jointly, as a household for the last 3 years, or you have a net worth of over $1 million, not including the equity of your home. And so kind of what's being suggested by this is you have deeper pockets and the ability, to maybe spice things up, if you will, a little bit. And you can pursue investments that haven't necessarily been passed through the Securities and Exchange Commission. So to some of what Logan was saying a moment ago, I'd like to talk a little bit about your experience working with accredited investors. But like an alternative investment, typically almost by default is something that is only offered to accredited investors. It isn't offered to anybody. And kind of what's being suggested by this is, the kid gloves are coming off. Usually we have higher investment minimums and more risk associated with this. And this could, do well. We'll see higher returns than what we'll see in the other space, but could also do poorly, and you could potentially lose a good chunk of money. So a buyer beware. So, Logan, as you were, migrating, into this real estate space, were you doing both the mutual fund work at the same time, or did this become like a full-time endeavor for you as you started to work with this? Was this just like the next part of your career as you, started to function as a general partner and, maybe had the responsibility of raising the capital, for the endeavor?
Yeah. And something I want to go back on maybe and clarify a little bit. So like alternative investments, I think what you're referencing is a part of what I consider the broader alternative investment space, right? Which tends to be direct placement type of things where you go directly to whoever's managing the project and invest. But in its broader sense, alternative investments are anything really that aren't publicly traded securities, which you talked about, right? Your Apples and your Microsofts of the world, where they go through a rigorous process and they have certain, quarterly reporting requirements. But if you think of things also like crowdfunding or what they call Reg A securities, which is just a SEC regulation under which you can issue certain securities, they still have to go through some level of SEC scrutiny and registration. And they do have certain reporting requirements that they publicly have to put out that are different than what a publicly traded company would have to do. And then you get all the way down to the direct investments where it's much less regulated, and you do have some of those income and net worth requirements. Crowdfunding, theoretically, you can do as little as $100, depending on the offering. So when I think of alternative investing, I like to think of anything outside of your traditional publicly traded stocks and bonds, treasury bonds, municipal bonds, corporate bonds, things of that nature.
Right. Well, so, and I appreciate that clarification because I mean, I suppose I know alternative investing and we have clients who participate in it, but my experience perhaps is maybe more limited than what the broader type of investment would be. And perhaps, again, as just a point of clarification, because I have a feeling maybe the listeners and the audience isn't as familiar with this. This is a really like, I don't want to call rarefied space or the like, but it's, kind of by default, it's alternative. It's not common. It's unfamiliar. It's not not the typical or the conventional approach. So, as a chartered financial analyst, they work on both sides of this. It's not like it's only exclusive to alternative space. You'll have plenty of chartered financial analysts who make decisions within mutual funds on publicly traded entities. So it's not as if the skill set is applied to one side versus the other. But, as your career had developed and your interests had developed, you had decided, and maybe just as chance would happen, right? I mean, you decided to go more deeply in this. And would you describe yourself as maybe having a passion in real estate? Like what kind of drew you to the opportunity of working with, with these partners and giving this a shot and, stepping away from maybe some of the other stuff? It is more regulated.
So I guess one thing I should mention is when I was at the mutual fund company, I was on the side doing kind of some single family investing. We didn't have outside investors or anything on that, but that was kind of my first foray into real estate. And, a lot of people know about real estate investing in different aspects, but so part of it was, I got the opportunity to go join another company. It worked well with my kind of lending background. To answer your earlier question, I did leave the mutual fund company completely to go be a general partner. One of the things I like about real estate is it's a hard asset, right? And you have theoretically some protection to the downside because you have an asset that you can sell versus, just the earnings of a company. That doesn't mean you're never going to lose money, right? But so that's part of the thing I like about real estate. And then people can understand real estate, right? Go walk out of your house. If you're in a house, right, you're in real estate. Right. Go walk down the street, go drive anywhere. People kind of intuitively understand real estate. And I would say that's probably one of the most common, if not the most common in the alternative space. But you do have things, private equity, venture capital, startup companies, that fall in that broader alternatives range as well. So to your comment too about CFA, I would say CFA charter holders are very prevalent in the traditional investing space, right? A lot of the mutual funds that your clients are probably in, if you really dug into the teams running those funds, they've probably got a lot of CFA charter holders. There's another designation, which I also have, which is called CAIA, C-A-I-A, which is Chartered Alternative Investment Analyst. And the simple way I describe that to people is it's the CFA for alternatives.
Okay.
So that would be another one in the alternative space you might see come up, and it's less well known than the CFA.
Right. And so, Logan, part of your work, to speak to some of your firm and your background and really just how, your work is rather distinct, especially within our network, is, this space, again, it's not registered most times with the Securities and Exchange Commission. I'll leave you to, correct that if I'm off. Sure. But, so you would be coming into almost uncharted territory as an investor. And so you might be like, well, I'd like to kind of get my hands into this, but gosh, I don't really know what I'm doing. And I don't have the education or the training or the background to even know if this is a good deal. Like, who could I talk to? And, typically your normal financial advisor like myself, I have some ideas as to some guidance on this, but it's really not my space either, because we typically provide investments through what you most commonly see with conventional approach of ETFs and mutual funds. And a lot of our focus is more on the personal finance. And a lot of that question starts to be not so much maybe investment return as management of risk and what can your finances afford, and what do we think is a good allocation of investment to your risk tolerance. But Logan, and his firm, this would be the person. If you're looking for that person, that's what Logan is. And so as we talked about your company, Alt Eval, maybe let's just give a chance a little bit, Logan, to talk about what your work is if either on an individual investor space or if you're working with a financial advisor and they have a client and they're looking for help. How do you help somebody who wants to participate in some of this space, but it's just I need help. This isn't what I know what or how to do.
Yeah, no. And the reason I started this is because when I was raising money, I heard a lot of investors say, I want to invest, but my financial advisor doesn't understand this. I don't really know what I'm doing. Should I do this? And it's like, well, I can't help you because I have a conflict here, right? But I thought maybe there's an opportunity to be that extension of their existing advisor, to work with them directly to, help them hopefully make better investment decisions, or at least more informed investment decisions. And so when I went out on my own, and I am a state registered RIA, so I have the same fiduciary duties that your existing financial advisor would if they're an RIA. But there's kind of two ways I will work with them. One, it's on an individual basis, right? So if you're looking at an apartment complex and you're not really sure where to start, you want somebody else to take a look at, then I would work directly with the client on that and do that fundamental analysis. Or the other way that we can kind of do that same process, but through your advisor, right? Or working with the advisors themselves as an extension of their firm to look at, in the portfolio context, how do we want to position it? So just as you as a financial advisor, the other financial advisors in this network would sit down and say, okay, what's the holistic plan here? What are the goals that you're trying to accomplish with your financial plan? What's your income situation? What's your net worth? All those good questions that a financial advisor should be asking. There may come a point where it makes sense to incorporate other investments, alternative investments into your portfolio. So how do we think about that? What types of investments make the most sense? How much of our portfolio do we want to allocate to this asset class? Do we want things that are perhaps a little more liquid, like an interval fund, versus a direct investment into a real estate project, which you may not be able to get your money out for many, many years? And so that's the other way, is just kind of still helping with that traditional planning, but in that very niche piece of the portfolio.
Right. Because to speak a little bit about alternative investing, thanks, Logan, for all that. Is it like it's not the norm. It's very different from what you would typically have. So if you're in an exchange traded fund, an ETF or a mutual fund, you can get your money in and out of that fund relatively quickly. Could be within just a few days, and trades can be placed almost instantaneously and settled. If not right then and there, settled by the end of that day. Today, alternative investing almost by default is the exact opposite. You have redemption periods, and maybe there's only open windows at certain times of the year or per quarter in which requests can be processed and handled. You typically have investment minimums that are, fairly substantial. Could be as low as, let's say, $25,000, but could be certainly over $100,000 to $200,000 to participate in the investment. And then there's just a whole sheer variety of potential investment opportunities that would come up. And, given the fact that you can't access the money quickly, you don't fully know what's going on because the person who's providing the investment, they have accounting, requirements or regulations that they're wanting to adhere to, but it's not, the information isn't as readily available as you might see with a publicly traded security. It's like, there's a very big risk that you could get yourself into this and then not sure how to get yourself back out of it. So before you ever say yes to let's do this, you want to do your due diligence. You need someone to look into this and say, what are you getting yourself into? And are you informed as an investor? And does this make sense, for you to say yes to? So, could you speak maybe a little bit about some of the initial due diligence? So, you would maybe look at a slide deck or the underlying proposal, what's called is it a PPM, Logan? What, maybe I'll leave you to kind of pick it up from there. What are the things that you're looking at on the outset of the investment to help the investor or the advisor make an informed decision?
Yeah. So some of the standard documents you would see, and we'll use real estate for an example, but it's largely similar documents, whether it's private equity, venture capital, whatever. So you should have what we call a pitch deck, right? Or a slide deck. And that's going to be a lot of your high level terms. If it's done well, they'll have some background of what we call the sponsor, the general partner, the person who's operating the project. What's their background? What's their experience? Who's on their team? What are the key terms of the deal? So in real estate syndication, for example, you'll generally have what we call a preferred return, which is the investor gets paid a certain percent, let's call it somewhere 6 to 8%. It can vary, but let's call it 6 to 8% first. Above that, any profits are then split between the investors and the general partner. Maybe that's 80-20, 50-50, but we're looking at those terms that are hopefully in the slide deck. What is the project? Is it multifamily? Is it industrial? Where is it located? How much debt are they using? What are their projected returns, right? Noting that they're just projections. There's no guarantees like any investment. And so that's one of the documents, and that's the initial analysis is, does this even make sense to go any further into this? And then you'll have what's called a PPM, or a private placement memorandum. That's that's full set of, here's all the risks, here's more details on the business plan, maybe a deeper dive on the sponsor. You should have an operating agreement, which is the legal document that governs how that partnership is going to work. It may outline terms as far as, what happens if the project starts to run out of money. Can we do what's called the capital call and call investor money in? And if the investor can't come up with the money, then what happens? So that'll be in the operating agreement. You'll have a subscription agreement, which is the form you fill out to invest. Depending on the deal, you'll probably have an accredited investor questionnaire, which is what you have to fill out to, prove you make, the right amount of income or have the right net worth to even be qualified. So those are those are probably the key documents you would have really in any opportunity like this, if we're talking in the direct investment space. An interval fund would be a different story.
Which I'm kind of curious what an interval fund is, because to be honest with you, Logan, I don't know what it is, but maybe not to go too much into the weeds on this. Like, I would say maybe real estate's the most common pursuit, at least that I'm familiar with. We do have a few clients who are invested in alternative investments, and I'll leave you maybe to add to what other variety you'll see. But perhaps, folks, you can see the value of just like needing to work either as an investor, or if you're an advisor looking for someone to go into the space to kind of guide you through, because it's a whole other animal, really. Like, this is a whole other uncharted territory. I think captures it best. Like, it's just completely different from what you've done previously, and like the risk that you're taking, the liability that you might be having, and the potential for both gains, but then for loss too. Is the stakes are just simply higher. So it's not a decision you want to take lightly. I am kind of curious though. I mean, if you're going to go, this is a lot more rigmarole than what you might see otherwise. What do you see, Logan, because you have deals coming across your desk all the time that you're kind of giving an eye out on, and you're looking for these, what would you expect or like to see in terms of expected returns? That's the thing that people are really interested in. Like, what kind of money can you make for me, and how much more return can I have than perhaps another conventional approach? Like, what kind of returns are out there for somebody who wants to go, down this path?
Yeah. So it's obviously going to depend on a number of factors, right? How experienced is the team? How'd they find it? How'd they find the opportunity? What are they, what's the business plan, right? A stabilized apartment complex that maybe just needs to be repainted and updated a little bit, is going to give you different potential returns, or hopefully give you different potential returns than, a ground up development where all they own is the land, right? And they've got to build the building, lease it up, get approvals from the government. Hopefully you're getting a much greater return, but again, more potential risks or things that can go wrong, right? So low teens to high to mid teens. In the heyday of what we call cap rate compression, right? 3, 4, 5 years ago, when you could pretty much buy anything and cap rates would go down, and I'll circle back on cap rates in a second, but people could buy things that weren't any good, and the price would go up, and they'd sell it and make, all kinds of, 30, 40, 50% returns. Like, you actually saw deals do that. I wouldn't bank on those, right? I would not expect those, but it can. So I would say something in the certainly high single digits, low to mid teens, depending on a number of factors.
Right. And so maybe just as a comment there too, you would certainly want to see a higher return. Like, if this investment was only, let's say, doing, 6, 7, 8%, which is not uncommon, maybe we would expect, let's say, an all-in equity portfolio would do within, the more conventional space. Then it's like, well, what's the point? Like, why take, to your example that you raised earlier, like, I mean, if you have two bonds and one's generating 5% and the other one's generating 5%, the other one's more leveraged, then it's like, well, why take that extra risk for the return? I mean, the same thing holds true here. Like, alternative investments by definition really need to generate higher returns, or nobody is going to pursue them. It just wouldn't make sense. So perhaps just to recap that, I mean, you're thinking somewhere, if someone went to this space, what you might commonly see as a range, and none of this is guaranteed, folks. I think you probably know that, but just to make sure we emphasize that, it's 12 to 17% returns. Maybe we're squeaking out early 20s, depending on how. I mean, higher return means higher risk. So yeah, maybe we get even into the 20s, but we're taking probably substantial risk of permanent capital loss, right? So that's what you would expect, though, or would be where you would be at least interested in an offering, is somewhere in that range. I'm gathering, Logan.
Yeah, if I saw that in a pitch deck, that would, again, on the surface at least, say, okay, this is probably reasonable, right? If somebody showed me something with 25, maybe that's possible, but I'm going to start asking a lot more questions, right? But yeah, I think teens.
Yeah, I mean, it's appealing as 25% return might be. What you have to read into that is recognize is like, no one just gives returns away. So if somebody is giving you 25% return, what they are suggesting is, either we're a more inexperienced team, or this is really aggressive, really risky, and the odds of it paying off are not certain by any means. Because if you could get a 15% return, as an organization, as a sponsor, then, kind of the exact opposite here. You want the return to the investor to be as low as what you think you need it to be in order to attract that investor. So like if they have higher returns, they're trying to attract anybody who's willing to take the shot at that. But there's a risk that's being written into that suggestion. So I suppose to your point, like, yeah, I mean, if you're seeing 25% returns, it's like, oh, that seems appealing, but it's like, how real is anything that's being offered here, right?
Yeah. And I think the other thing to be mindful of, this is true of any investing, right? Whether it's mutual funds or alternatives or whatever, is are those net or gross returns, right? Meaning, is that before the fees come out, or is that after the fees? And in these direct investment opportunities, that's especially prudent because they are going to have higher fees than you see in an ETF or an index fund, right? Like, that's the nature of them, and to make them work. And the sponsor, the operator, is not working for free, right? Like, they are deferring oftentimes much of their pay on the hopes that they can make more later, right? They're taking a long-term view too. But if it works, then they want to get paid. So it's important to be mindful of, are those projected returns before or after all the fees come out?
Sure. So, and there's tax ramifications. Like, it's so much, just to reiterate, like, this, having a full understanding of what you're getting yourself into here is just so important, because it's the possibilities and the variation that you'll see of this, of a more conventional investment, are just, it's rather staggering, right? I mean, you could potentially handle this as just taxable brokerage account money, where it's a direct investment in which the taxation immediately comes home to you, but you could potentially also have this invested through a qualified account, like it wouldn't be a 401k, but maybe an IRA holding, or even an inherited IRA, provided whether or not the sponsor's team can make all that the paperwork work for these details. So, but there could be losses that are coming home that could be a tax benefit to you on your return, but there could also just be direct income that's being generated here that's now that you're paying taxes on, and it could even be the case that income actually isn't coming home to you as the investor. It's just what incurred within the syndicate that you're now needing to pick up. So there's just many things that are taking place in this investment type that requires good education to make sure that you are, again, as an investor, making an informed decision. Logan, as we start to think of closing things out and winding down the conversation, I mean, in my mind, it's really just indisputable the value that you're bringing to either the investor or the advisor. This is, again, an uncommon space. There's not a lot of guidance here, lots of questions, lots of room for error and mistake. Usually because the higher investment minimums, there's plenty of opportunity to to lose money. So having someone that you could trust to help guide and walk you through it is, I think, money well paid. What are some of your takes on the alternative investor space that you'd like maybe to just share with the audience, as for kind of a final takeaway or thought for the show?
Yeah, I think it's, obviously I'm biased, right? But I really like it. I think it's an opportunity to diversify your portfolio a little more than maybe you already could. You hinted at, and I'm not a CPA, that's not tax advice, right? But some of the tax benefits or costs as well, right? But these deals are often taxed as partnerships. So some of the, people like real estate investments because they pass through depreciation, right? Paper losses. So yeah, I really like the asset class. And then, from a faith perspective, I think it's easier to invest in alignment with your faith when you're going direct to some of these opportunities versus the public companies. Now, there are obviously good faith-based ETFs and index funds and things like that out there. So that's not a knock on them. But I personally like the space. Obviously, I'm building my business around it, right? But I think it's worth, if somebody wants to look at other opportunities besides their traditional stocks and bonds or other things out there, then I think it's worth looking into it and at least educate yourself, right? Or talk to somebody who can help educate you.
Absolutely. Yeah. And I think to that point on the moral investing, or at least instituting some screens or a mindfulness to your investing, because as I was thinking about this, it's almost like you're getting closer and closer to ground zero on this type of investment. Like when you're in the publicly traded market space, technically you're a shareholder, you have voting power, you could, you have some ability to persuade or influence maybe how a company is being managed. You're usually, as a shareholder, you're one of millions, right? So, your ability to really influence that company's direction is pretty minimal. But, and it maybe even in this space, you can't necessarily influence the company's direction, but you can be selective or really aware as to what exactly this investment is doing and whether or not you find that to be with the goals, your values, which you want to be accomplishing in life. And so you do have greater control as to, how your money is being allocated or applied. Now, as to whether or not to go 100% into the alternative investing space, maybe I'll leave Logan for you to chime in and give some thoughts. I would have hesitance as an advisor to have someone go that way. I feel like that would be really aggressive. But at the end of the day, if you also want to build wealth, you need to do that in through concentrated manner, or it's the best means. Like concentrated investing is how you grow your wealth. Is also how you can also lose all your wealth. So, but to each their own in terms of the risk allocation in this. But like, it's not a bad idea. Like on the face of it, it's like, well, if you really want to get behind accumulating wealth, this could be a good way to do it. But, you have a good guide is what I would say. Like, there's a lot of also risk that you're taking. I don't know, to your point, Logan, or my question earlier, like, would you recommend someone going 100% in? Like, how much do you think it's a good amount to go in the alternative investing space? Like, what's your kind of feel for that?
Yeah. Like everything, right? It depends on the investor situation, but I would not suggest 100%. And I probably wouldn't even suggest 50% ever, right? It's, in my mind, it's part of, like any good financial plan, it's part of a well-balanced portfolio that's designed to achieve your goals and, meet you where you're at in your life, right? So my personal portfolio is nowhere near 100%, right? And not even half. So as an advisor, I wouldn't tell somebody to do something I wouldn't also do. And I can't imagine a scenario where I'd ever advise somebody that was a good move.
No, I would say typical considerations here are probably 5, 10, maybe as much as 25%, depending on a person's, eagerness to be in this, and a number of considerations. But 5 to 10% is typically what I would advise and see and recommend. But, we have a few clients, for what it's worth, who, they like, a healthy dose of risk, and they're fine with it, and they want to be aggressive. And so, there's, it's fun, I think, to let clients and investors kind of pursue these if they seem to have the right temperament and attitude and mentality and have the wherewithal, really. Because, as much as we hope to see higher returns here, you could really take a big, punch to the gut, right? And you got to be willing to see those losses, because there's That's going to happen too. And there's really no way, even with good guidance, to know for sure that a loss isn't what's going to be the final outcome here. And so you got to take the good and the bad together. Well, Logan, if someone was, would like to reach out to you and connect, what's the best way? Who should they, how can they find you?
Yeah, I think the best way is to go to my website, www.altseval.com. That's ALTSEVAL.com. And there's a contact us section on there. You can fill out its quick name, what's your name, what's your email address, and why are you interested, and go that way and connect from there.
Well, great. Well, Logan, thanks for being on the show, folks. We really appreciate the value and the service that you're offering and the point of difference. But, Logan, as a reminder, folks, isn't meant to be a replacement to a financial advisor. It's meant to really be a supplement or an enhancement to work alongside an advisor. And there's two different skill sets that are taking place here. Logan can help with a more in-depth understanding of investments and perhaps your portfolio and its design even, and making sure that this investment at least, checks all the boxes and we feel like you're making an informed decision as you take it on. But you also need someone who's helping you plan your finances and figure out what's important to you and, what's the future hold, and, what are the changes maybe that you need to be implementing or doing today to keep your finances in a good trajectory. And that's where, a financial advisor works. And so just would encourage anyone who's on the show, to check out the Catholic Financial Planners Network. You'll find a good number of faith-based advisors who can help you in all those equally important decisions too. And so maybe through the collaboration of both the advisor and Logan, or, the investor and Logan, we can make good decisions for your future needs and ultimately for God's kingdom. So for everyone who's been here, thanks so much for your time and attention. Hope you found a lot of value out of this. Be sure to reach out to Logan. Be sure to reach out to the Catholic Financial Planners Network. And between now and then, God's blessings to you.
Thank you, Ben. Thanks for having me on.